Well, thank you very, very much for taking the time to listen in. I'm always grateful for any opportunity we get to talk about hedge funds, because it's so hard for us to get any press in the industry. Everybody just seems to be ignoring them every day, and the press we get is so good. Why would you want to mess it up? But I thank you. I've been doing this at Merrill and Chase for 10, 12 years now, from beforehand, and from way back when this was really a much smaller and a very different industry. I had been, as Tony was so kind of saying in his generous introduction, I'd been the CIO at the Chase Manhattan Bank on the private bank before joining Merrill, and I joined in 1997 thinking that it was a smart move to make the switch from traditional assets to alternatives. My father-in-law, who's an English professor, had no idea what hedge funds were. Then 1998 happens, and he reads all about long-term capitals and wonder why he allowed his daughter to marry me. But since then, it's been an up and down ride. But actually, for hedge fund investors, it's been a highly profitable and actually lower risk ride certainly than in any of the long-only assets, and far greater than the vast majority of people would expect and would know. But there's been changes in the industry, and I do believe that over time, hedge funds will in fact end up being something that you'll be seeing a lot more of in the portfolios and demanded by your clients. The questions are out there. Is there too much money in hedge funds? What do the strategies' returns look like over time? What is the composition of that strategy and the net asset flows? How is the money flowing into and out of hedge funds, and how is that looking over time? And so one of the things that I think is most important is why are people investing in hedge funds? And that reason really does vary depending on the investors. Diversification, seeking a different alternative to their equity risk premium. They're willing to take that risk, and they want to diversify it. So they're looking for assets that are not going to be moving like the other assets in their portfolio. And let's be honest, look at the diversification that we talk about in a lot of portfolios. We're going to be diversified, mid-cap value and large-cap value. To the private investor and to a lot of institutions with liability issues, those look an awful lot alike in their total return profile at the end of the day. Structuring alpha and risk budgeting, taking the alpha from a market neutral product, get a product that's not related to it, and then where you want to take market directionality, take market directionality, and they add it that way. Absolute returns and liability driven mandates. One of the things that is important in a lot of products, we're not talking about our own products, though this would apply to us and many, many other funds, is you really very, very rarely have had entire years with a down year. And being able to start the year with $100 at the end and start the next year with at least $100 makes such a large difference. If you look at a lot of investors in long-only assets, you look at, there's great excitement that the Dow might reach the levels that it was at years and years and years ago. So when people, and the ugly truth of it is that when you have a 20% down year and you go down to $80 in NAV, the next year you've got to have a 25% year, and you're still not there. And you're only then, before inflation, back to your $100. When people lose these sort of 30, 40% drawdowns, you're talking 80, 90% recoveries in the following year just to get back to par. So having $100, continuously trying to avoid capital losses, is a big part of liability-driven strategies. And accounting standards have also made the greater stability more important. When I started in this business a while back, if we go back to like 1994, what was it then? Rolodex-based investing. There's a bunch of guys who knew you only had 99 slots in a hedge fund. Bill's got a spot open. George has got a spot open. Why don't we do that? And they were largely unregulated. It was a few very large hedge funds that were little funds of funds themselves. They'd have smart traders, and they would bring them in. What is a fund of hedge funds? I mean, that was just simply an unknown. And it was predominantly high net worth investors. Nowadays, not who you know, but what's their alpha, and a lot of quantitative work to determine